Look, folks, China is undoubtedly the largest automotive market on the planet. But its EV sector in 2023 so far is showing us some signs of cracking, as BYD has just slowed down production of some of its top-selling plug-in hybrid and battery electric vehicles, and recent insurance data showing us the demand for plug-in electric vehicles is starting to slow down from 2022. Whether it be geopolitical tensions or a lack of good policy, China has been a massive player in the EV industry, but that strength is starting to not continue this year. In this video, I want to address some of the factors that are leading us towards this conclusion and how it will affect some of the most established automakers like BYD, Tesla, and the foreign brands, along with startups like Xpeng Motors, Nio, and Li Auto. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's discuss the reasoning behind this video, which was an article that just came out about BYD reducing its shifts at 2 EV plants in China. There could be multiple reasons why this could be happening, obviously. You could have the company investing in cost reduction plans, having overproduced and invested in its manufacturing plants. But given how China's economic recovery has played out, I think this has mostly to do with slowing demand and growth compared to last year. Around a quarter of all cars sold in China are electric vehicles, and by 2030 we expect EV sales to surpass internal combustion engines. But because of the way the industry has grown in 2021 and 2022 through the midst of a massive property crisis, it seems like consumers are now more desperate to save cash and spend less money on electric vehicles that might be too expensive. And why would that be the case? Well, as you can see, China's top 10 EV models last year were indeed either plug-in hybrid or very cheap city cars. The Wuling Hongguang Mini EV was the #1 model from a company that most have probably not even heard of. Number 2 and number 3 were the BYD Song and the Tesla Model Y, which obviously are not luxury vehicles per se, but are more the mass market vehicles from both OEMs. And as you can see, every car that has a green and a gray leaf next to it is a plug-in hybrid vehicle, not a fully battery electric car, meaning the majority of the top 10 vehicles shown in this graphic are indeed not fully electric, which means consumers are hesitant to buy and convert completely to battery electric only given its charging infrastructure restrictions and potentially higher costs. Even one of the industry's slowest growth EV automakers by the name of General Motors is entering the EV market through a joint venture with GAC and Wuling. They're expected to launch a new city car in 2023, putting them number 2, believe it or not, on automotive EV market share. And this is where things get a little bit bleak, because most of the data that we see out there comparing sales for BYD, GM, Tesla, and some of the other EV automakers do not distinguish between plug-in hybrid and fully battery electric. This means a lot of BYD sales, for example, do include their plug-in hybrid, which I personally do not consider to be an electric vehicle. Tesla, for example, experienced a 5% year-over-year drop in its market share in China, not only because of its production halts in April and May of 2022, which by the way some other companies also experienced because of the shutdowns, but mostly because of the lack of growing demand. This is a big reason why Tesla cut prices in China, because that is where they have the highest gross margin. Meanwhile, BYD, which obviously sells plug-in hybrid vehicles, grew its market share by more than 11% year over year in 2022. For a company that sells more than 3 million units a year, that is significant growth in a market that is obviously growing itself significantly year over year. And why exactly do I think this is a problem for the overall Chinese EV industry? Well, because this is a signal for traditional OEMs like GM, Toyota, and Honda to enter the Chinese EV market being branded as plug-in hybrid to be able to market their own ICE vehicles. BYD obviously right now is a top-selling automaker, but a big reason for their super performance has been because of their traditional ICE business, which they did cut out in 2022. Because of their manufacturing ability, they were able to enter the Chinese EV market and create more comfort for consumers while being able to develop their plug-in hybrid and slowly innovate on their battery electric. And this right here is the real issue with the market in 2023. You just have an oversupply of too many brands providing too many product offerings to the Chinese consumer at a time when demand is slowing. Kia, GM, and Honda are now planning to launch some of their latest EV models in this industry, and that includes hydrogen fuel cells, which obviously offer their own value proposition separate to battery electric. This most likely means that the companies that have some of the biggest market share right now, whether that be Tesla or BYD, have to compete more aggressively with their product offerings. This also means that startups like Nio and Xpeng Motors have more competition coming up, meaning their profitability is most likely going to suffer in the short term, especially if they don't scale fast enough. And that's obviously because China has the most competitive pricing of all EV markets. Some of the cheapest vehicles in China are worth around $5,000 brand new in the EV market, and something like the Nio ET5 right here offers a 620-mile range compared to the 315 of the Tesla Model 3 at the exact same price. Something like the Nio ES8 offers a much better range, more space, and more features than something like the BMW iX, not to mention its ability to battery swap and access a better charging network. And then you have something like the Xpeng P7i, which just got refreshed with a higher range, an LFP battery, and navigation-guided autopilot, which mimics what Tesla's FSD does in the US. Not only do you get an extremely pleasant driving experience, a very good-looking vehicle, but also 175 kilowatt fast charging, all for $49,000 US. Compare that to a Model 3, which costs around $53,000 US. You can see why the Chinese EV market is growing so competitive. However, it turns out that is also its biggest problem. You're seeing earnings from Nio and Xpeng Motors come out to be a lot poorer than Wall Street in the US here has expected. Not only are costs rising, but particular demand for their models are going down, mostly because of new entrants in the market from not only startups or foreign automakers like BYD or Tesla. Ford and Volkswagen have both cut over $6,000 off their EV offerings. Meanwhile, GM is expected to start running promotions to boost its gas car sales from Chevrolet and other brands in China, because obviously GM does not sell its own branded EVs just yet. These price cuts are clearly a sign of the growing competition and saturation of the EV market in China, which is a complete contrast to what we experience in the West, where we only have a handful of automakers that are selling us purely battery electric vehicles. In China, on the other hand, this will most likely act as a headwind for sales in the short term compared to the rapid growth we saw over the past few years. However, for the long term, I think this is going to act as a massive beneficiary for the consumer and investors that pick and choose the right businesses. And I think particularly a lot of that value creation is going to take place in the startup space, whether that be through Xpeng Motors, Nio, or Li Auto, which are some of these unprofitable cash-burning companies in the short term, but with their new value propositions and technological readiness, they could create their own brand opportunity in China, whether it be full self-driving, higher range, lower costs, or more features. The consumer and the industry as a whole is going to benefit the most from this competition. Let me know your guys' thoughts down in the comment section below, as well as your take on whether or not this is a right time to be invested in this highly competitive space. As usual, guys, let me know your thoughts, and I'll catch you guys in the next one. Take care.